In this week's video, we'll examine the charts to help us answer the question, is the market setting up for a post-election plunge? We have a lot to cover this week, so we will be moving very, very quickly. We'll see what we can learn from the short side of the market. We'll review numerous 2016 charts. We'll talk about evidence in hand relative to inflation expectations and investing. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. To open the video this week, we're going to examine the present-day market from a different perspective. This is the Ridex Inverse NASDAQ 100 fund. This fund goes up when the NASDAQ 100 goes down. It has trends like any other investment. This is the 200-day moving average here. You can see when the dot-com boom was still going on in 1999, the long-term trend for shorting was unfavorable. But then the 200 days started to flatten out, and it turned up on November 13th of calendar year 2000, telling us now that the long-term trend for shorting, or the inverse NASDAQ 100, was now favorable. Was this helpful here? The answer is yes. When the long-term signal came for the short side of the market, or the inverse NASDAQ 100, after that, after the 200-day moving average turned up for the inverse investment, the NASDAQ composite lost an additional 62% from this point here to the end of the bear market in October of 2002. Was the long-term trend of this inverse investment helpful at the stock market bottom? The answer is yes. The stock market bottomed in 2002, but it had a significant retest into the spring of 2003. So the longer-term trends, the easy part of it, started in the spring of 2003, a new bull market. This is the NASDAQ composite here. It bottoms and it rallies. Here we can see now the 200-day moving average for shorting. We've gone from a favorable long-term trend to short to an unfavorable trend. When it rolled over here, indeed, good things did happen in the stock market. Was the slope of the 200-day moving average for our inverse investment helpful in the early stages of the financial crisis? The answer is yes. The slope turned up here. This is a bullish long-term signal for shorting the NASDAQ 100. It turned up on January 22nd, 2008. After that, after we could see it, the S&P 500 lost an additional 49%. And after this turned up here on January 22nd, 2008, the NASDAQ lost an additional 45%. And when the stock market bottomed in 2009 on cue, the long-term trend for our inverse investment, or shorting, rolled over here in July of 2009. And after that, good things happened on the long side of the market. Quick recap. The long-term trend, or the 200-day, for the inverse or shorting turned up. This is a bearish signal in 2000. This is the look we want to avoid if we're long stocks. This is the look we want to avoid. Here's the bearish signal in 2008. Conversely, this is the look we want if we're invested in stocks or looking to redeploy our cash. The 200-day rolls over for shorting, or the inverse investment, in 2003. It does the same thing in 2009 here. Therefore, in 2016, do we have this concerning look here, or do we have a 200-day moving average that's flattening out, or do we have something that looks more like the right side? This is the exact same Ridex Inverse 100 fund on October 27th. So this would be as of Thursday's close, and you can see the slope of the 200-day moving average is clearly down. In fact, if we zoom in and change the scale so we can focus on the change of the 200-day moving average and remove price, we can see that thus far the slope is clearly down and the change is a negative change and a negative slope, and we don't have anything yet that looks like somewhat of a flattening process or turning back up. The present day does not look like the two examples we want to avoid. Is it possible this starts to flatten out in the days and weeks ahead? The answer is absolutely, positively yes. But a couple of weeks before the election, we don't have somewhat of a flattening out or bearish turning look at this point. This investment does not seem to be setting itself up for negative outcomes following the election. Obviously, that is subject to change, but that's the information that we have in hand in this case as of the close on October 27th. The vast majority, if not all, of the charts for the remainder of the video will be as of the close on Friday, October 28th. S&P 500 monthly, resistance in 2015, resistance in 2015, resistance in 2015, and a stall here near the top of the box in 2016. What once acted as resistance may now act as support, and you can see that comes in somewhere around 2100. Similar situation with the NASDAQ monthly. What once acted as resistance may now act as support. Same concepts apply to the Dow. We have a longer-term consolidation. Box, a bullish breakout here, and what may be, and it's yet to be determined, a retest of that successful breakout. If you follow the markets closely, you know there are some concerns about European banks. This is European financials here. Here's the plunge after the Brexit vote. These are the Fibonacci retracements here. As of 3:36 p.m. on Friday, October 28th, European financials were holding above that 61.8% retracement. All things being equal, if you're bullish, you would prefer to see European financials stay above this retracement and above this consolidation or Brexit box here. Similar situation, but now we're looking at an A to B fib for the NYSE weekly. This is the drop 2015 into early 2016. We go above the 61.8% retracement, and now we are revisiting that area. The close was 10,476, which is slightly above the fib at 10,464. We'll learn something either way here. We're still above the peak that we've been watching in past videos from 2007. You can also see it if we look at the NYSE Composite Monthly. Here's the peak in October of 2007, and we've been hanging around that general level here, and now we're back to the top of the box. This is stocks versus bonds weekly. We know we've had a lot of false breakouts, but right now it looks like stocks are trying to break out relative to bonds after several months of indecisive behavior. S&P 500 daily, we had a trend channel here, the bottom of the trend channel in October of 2014, top of the trend channel here, bottom of the trend channel in early 2016, and then we broke out above what had acted as resistance previously. What once acted as resistance may now act as support. We also have several areas of resistance here shown by the orange lines that may act as potential support. They come in at 2100 and above. Just a quick reminder about low volatility periods. This is the Bollinger Band width here. When it gets down to these low levels on the monthly charts, it basically says we've had a period of consolidation or low volatility here. When we got down to this extreme level in 1985, after a long period of frustration, good things happened for several years. Similar situation in 1995, a lot of whipsaws and frustration. Here we get down to a very, very low level on the Bollinger Band width. After that, good things happen for several years. Fast forward to calendar year 2005, we're down near the same very low levels. We have a consolidation period. Here, after that, good things happened for several years. How does this chart look in 2016? The answer is very, very similar. The Bollinger Band width has only visited this type of level 1, 2, 3, now the fourth time dating back to 1982. Is it possible that this period of low volatility is followed by a period of higher volatility by dropping below the consolidation box here? The answer is absolutely positively yes, but the data that we have in hand right now still favors a breakout above the long-term consolidation box. It's a zoomed-in view of our long-term consolidation box dating back to 2013 for the S&P 500 weekly. You can see, like the daily chart, we've got some areas of possible support in the 2100 range. And we know from past videos that periods of consolidation and frustration and whipsaws, periods of frustration, consolidation, and whipsaws, periods of frustration, consolidation, and whipsaws are often followed by easier periods marked by stronger trends, are often followed by easier periods that are marked by stronger trends. Here's the same concept of a downward sloping trend channel. Now we're looking at it on a weekly chart, and we're back here. Successful bullish breakout. This is a retest here. We don't know if the retest is going to pass or fail. That falls into the to be determined category. This is an updated version of a daily chart we've shown a few times in recent videos. This is our Brexit box here. You can see we're almost coming back and retesting the breakout from the Brexit box. We'll learn something either way. Quick Fibonacci retracement update. Here's our A here, the Brexit low. Here's our B, the peak. Normal retracement of this A to B move could be 61.8 here, 50% here, or 38.2 here. On Friday, October 28th, we were still trading above all three of these fibs. How about from a longer term perspective? Our 30, 40, and 50 for illustrative purposes only weekly moving averages on the S&P 500. Do we have a look like this a couple of weeks before the election? This is a look we want to avoid here after we get the full bore bearish look. In this area here, the S&P 500 drops an additional 47% from point A to point B. A few weeks before the election, do we have a similar and concerning look to this period here in early 2008, where blue is on the bottom and the slopes of all three moving averages are down? After we could see that, in this case, the S&P lost an additional 52%. Here are the same weekly moving averages here on Friday, October 28th, and you can see it really doesn't look anything like this concerning period in early 2008 or this concerning look here late in calendar year 2000. Is it possible that the Fed or the election causes another whipsaw here? Absolutely, positively, yes, it's possible. However, when we go through the rest of the video and we look at the weight of the evidence, it doesn't seem to be leaning that way as of October 28th. Obviously, that's subject to change, but this video covers the information that we have in hand today. Right now, price is above all three moving averages. Blue is on the top, and the slopes of all three of them are up. The present day really doesn't look anything like this pre-plunge period here in late 2015. We'll finish up the video this week looking at numerous weight of the evidence type charts. We should ask ourselves, what can we learn from the evidence that we have in hand? The transportation average here, resistance, 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 resistance. This dates all the way back to August of 2015. You can see now we are above that. We have a bullish breakout here, a failed breakout, but another bullish breakout, and right now we're holding above this line. All things being equal, this is a more favorable look here than what we had here earlier in 2016. The longer we stay above the blue line, the better. We'll learn something either way. It's a long-term chart of crude oil, which tells us something about the economy and inflation expectations. This is crude oil weekly. This is price here. You can see price from point to point, from here to here, has a downward slope. Over the exact same period, point to point, RSI for crude oil has a bullish or positive divergence. This line has a negative slope. The same line for RSI, point to point, has a positive slope. We also have what appears to be somewhat of a bullish breakout, resistance, 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 and like the transportation average, right now we're above the red line, and this is telling us it's possible that this breakout will hold and eventually crude oil will push higher. S&P 500 weekly, it's easy to see resistance here, support here. We're back to the same level. It's also easy to see if this blue line does not hold. You can see we have potential support here. I could draw a line across here on the weekly chart, and that comes in right around 2100. The German DAX has a high correlation to the S&P 500. It's not likely that the S&P 500 would go up for 7 years and the DAX would fall for 7 years. April of 2015, we stayed below this trend line. Now we're above it. This here looks better than this here, or even here. It's somewhat subtle, but it is an improving look on the chart of the German DAX. You can make an argument that the weakness in small caps here is a retest of this bullish breakout. We'll learn something either way. We can learn something about the market's expectations relative to future economic outcomes and inflation by looking at a diversified basket of commodities. Physical commodities are the CRB index. You can see here 2014, 2015, we had a long-term downtrend. This is a very unfavorable period for commodities, and now it looks like the 200-day moving average is trying to turn back up in a bullish manner. All things being equal, this speaks to rising inflation expectations, and historically, that's been favorable for stocks relative to bonds. We can use the ratio of TIPS to intermediate term treasuries as a proxy for inflation expectations. You can see during the financial crisis, inflation expectations in calendar year 2008 were plummeting. It was not a good time to be in commodities or stocks. And then in late 2008, early 2009, inflation expectations start to pick up. And this was a more favorable period here on the right side for both stocks and commodities. This is a consolidation and a breakout. We have a similar look here. Sideways movement. This looks like somewhat of a bottoming process in inflation expectations. And we have what appears to be a bullish breakout. It was good for stocks and commodities here. It's possible if this breakout holds that it would be favorable for stocks and commodities, especially relative to bonds going forward in calendar year 2016. We have had a lot of false breakouts, so we'll see how this one works out in the weeks and months ahead. Similar situation here. Silver tends to have more industrial and real-world uses relative to gold. So when the economy is stronger, typically, and when inflation expectations are higher, typically silver will outperform gold. You can see from 2011 into early 2016, the silver-gold ratio was clearly in a downtrend here. We've broken above these trend lines here. We've made a higher low in the ratio here relative to this low, and a higher high here relative to this high. And now it looks like we've got a retest of this breakout here. We'll learn something either way, but if this turns back up, that tends to be good for both stocks and commodities. If the breakout fails, tend to favor bonds over stocks and commodities. Similar situation here. Gold relative to treasuries, long-term downtrend 2011. We can see somewhat of a consolidation and an attempt at a bottom here. Resistance, 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 resistance. As of October 28th, the ratio is now above both of these blue lines. Economically sensitive energy stocks, or XLE, in the ETF world. You can make an argument this looks like somewhat of an inverse head and shoulders pattern. This would be the left shoulder, the head, and somewhat of a messy right shoulder here. But more importantly, support, what once acted as support may now act as resistance, trying to get a breakout here above the blue line. We'll learn something either way with XLE. We noted rising inflation expectations tends to favor stocks over bonds, and you can see the weekly chart here, resistance, resistance. Now we're above the blue line on October 28th. A long-term messy box here for the ratio of technology stocks to intermediate-term treasuries. Resistance here in 2015, price was rejected. Now we have what looks to be a bullish breakout above this level here. Is it possible that TLT rights itself relatively soon? Well, anything's possible, but we have support here, support here, support here, support here. We're moving back toward this rising blue trend line here. We'll learn something either way. This trend line dates back to late calendar year 2013. Last week, we covered the slope of the 200-day moving averages and the Fibonacci retracements for numerous ETFs. This is GLD as of the close on October 28th. Price is above the 200-day moving average. The slope is still favorable, and we're still above all three of the major A to B fibs. Everything that we just said for the chart of GLD also applies to SLV on October 28th. The longer we can stay above the 200 and the three major fibs, the better the odds that we're in a longer-term uptrend and eventually we'll make a higher high above the previous high. Similar situation for SPY. Slope of the 200 still favorable, and we're above all of the fibs. If we use this as an A, this is an A, the Brexit low, and this would be our B. Dividend stocks, resistance, resistance, resistance here. We're back to the three blue lines. We also have a rising 200-day moving average and the green and blue fibs down below that might act as possible support. Slope of the 200 and the blue and green fibs still look favorable for the total stock market, or VTI, as of October 28th. And the same can be said for XME, or metals and mining. Emerging markets EEM, a confused mess here for several months inside of this box. However, support, 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 resistance, resistance in this area, bullish breakout here. Again, you can make an argument this is a left shoulder, a head, a right shoulder. If that's the case, the longer we stay above this neckline here, the higher the probability that good things happen eventually for EEM. When we study charts with the benefit of hindsight, it seems incredibly easy to avoid a big loss like this when we look at moving averages. We can see the evidence changing in here before really bad things happen. However, when we look at this chart here, we don't have emotions in the equation and we don't have our ego in the equation. It's much, much harder to execute in the real world with the day-to-day noise. It's also very, very difficult to stay with a system when you have a long-term frustration box with whipsaws. With the benefit of hindsight, it seems easy that when we get the bullish setup here, to capture the gains here. However, in the real world, when we have a situation where the broad market is roughly still 8% below the 2015 peak, or 6% below where it was in July of 2014, it's easy to understand how people following systems break the rules and get discouraged, thinking it doesn't work. All of the math that we cover here doesn't look particularly difficult, which brings us to an extremely important point that's captured in this quote from the book Market Wizards. It's not the mathematical skill that's critical to winning. It's the discipline of being able to stick to the system. In these incredibly frustrating periods where it is difficult to stick to a system, we need to keep in mind and maintain our focus on what we can control, proper execution, and our attitude, rather than things that we can't control. We can't control the volatility inside of this box. However, we can execute consistently to give ourselves a chance to participate in what is typically an easier market that follows a difficult market. What is typically an easier market that typically follows a difficult and frustrating market. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.